Not a lot of people realize that you can offset all of your annual income taxes going forward and not pay a dime of taxes on your W-2 income or active income going forward using short-term rentals as the tool to do it. Even if you're watching this and you make multiple six figures and maybe you pay over six figures of annual income taxes, this tool could offset all of that. So I'm going to explain how to do this using an example that we're working on right now. So we own a 3-unit property that we bought at the end of 2022. And we bought it with the intent to rehab it, and we put it on Airbnb as a short-term rental last year in 2023. And so right now, we are doing what's called a cost segregation study. And essentially what that is you bring in an expert who's a cost segregation or cost seg expert, and they break down all of the components of that property. And they break them down into how long those components should last. And so what they're trying to do is identify all of the components that are going to wear out much quicker than the rest of the property. And these are things like flooring and appliances and stuff like that that's going to wear out quicker than more of the structural items in the property. And what the IRS allows you to do with these items, these components that wear out much quicker, is you can do what's called a bonus depreciation on those items. And what a bonus depreciation is basically where you just front load the writing off of those components against your active income. The only caveat to this that the IRS provides is that you must do what's called materially participate in the functions of your short-term rental business. And the reason why this is called a short-term rental loophole when it comes to taxes is because when it comes to long-term rentals, the test that the IRS provides in order to write off losses on your long-term rentals against your active income is that you must be a real estate professional. And the standard to become a real estate professional is very high. It's almost impossible if you have a full-time W-2 job to become a real estate professional, which is the whole point, is you want to offset that W-2 income. So it's kind of a catch-22. But with short-term rentals, the IRS says you just have to materially participate, and they lay out 7 tests that will, as long as you meet one of these tests, you're considered materially participating. And really there's 3 most short-term rental owners shoot to pass one of these 3 tests. So the first one is you spend 500 hours in the year that you're doing the cost segregation study working on your short-term rental business. So as long as you exceed 500 hours, then you're good as materially participating. A lot of people don't want to spend 500 hours working on their short-term rental business. So another test is that you do substantially all of the work. Basically, you're doing everything on your short-term rentals. That qualifies you to materially participate as well. The last one, which is probably the most common that people shoot for, is as long as you spend 100 hours throughout the entire year working on your short-term rental business, and that exceeds anyone else. So if somebody else works 100 hours, you got to work 101 hours. But as long as it's 100 hours and more than anyone else, then it qualifies as materially participating. The next logical question then is what activities count toward these 100 hours that you have to work in your short-term rental business? And the IRS is a little bit vague here, but it's a lot of activities. It's not just like cleaning your short-term rental or managing your short-term rental. There's quite a few activities. So I'll just read it right from what the IRS says. So it says any of the following activities would qualify as material participation: real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental property operation, management, leasing, and brokerage, trade, or business. So that's a lot. You know, if you're searching for property, going through the acquisitions process, rehabbing a property, these are all things that count toward this 100 hours that you need to exceed in your short-term rental business. The final stipulation that makes your property considered a short-term rental as opposed to a long-term rental is that the average stay of your guests must be less than 7 days. So for most people who have short-term rentals that listed on Airbnb, VRBO, this isn't going to be an issue. Most of the time, your average stay is less than 7 days. So now I'm going to show you an actual example of how powerful the tax savings can be even on a relatively low-cost property that we're doing a cost segregation on. So this is not the cost segregation study itself. This is a feasibility analysis. And this was provided by Yona Weiss of Madison Specs. He was a guest on my podcast about a year ago. You can go back and listen to that episode if you want more information. But essentially, I gave him the basic information, and then he told, this is a breakdown of what I could expect, a ballpark of what I could expect in terms of tax savings. So this property, we have about $325,000 total into the purchase and renovation of the property. However, with the cost segregation, you're excluding the land value because you're not depreciating the land value, you're just depreciating the structure. So after they remove the land value, there's $255,252 that can be written off or depreciated. And if we do the traditional depreciation method, then, and we don't do the cost segregation study, then it will be over a 27.5-year period. So it'll be straight line depreciation. They'll just take that $255,000, they'll divide it over a 27.5-year period, and that's the amount that you can write off every year. However, what we want to do is we want to front load that depreciation to write off a whole bunch more this year. So this is the breakdown of the different components that can be written off over a certain period of time. So the structural components, the components that won't wear out very quickly, those are going to be excluded. Those are going to still be in the 27.5-year time horizon for being able to be written off. But then there's 15-year components and there's 5-year components. And so you can see that it's about, 36% or 37% of those components over that time frame. And so when we look at this breakdown, you can see that this is the regular accelerated depreciation. But what we're really wanting to look at is the 100% bonus depreciation. Now, I have to clarify that if you bought a property between 2018 and 2022, you can write off 100% of the depreciation, the bonus depreciation, in the first year. That is slowly being phased out. There's a lot of people who think that it might come back, but in 2023 it was 80%. So this value of the amount that we could depreciate 100% in 2022 is going to go down if you bought it in 2023 to 80%. In 2024, it's 60%, but it's based on the year you purchased the property. So since we bought this one in 2022, the components that we can bonus depreciate in the first year add up to $96,922. So if you scroll down here, you can see what the tax savings with cost after tax benefit in the first year with cost segregation would be around $40,000. So basically our tax benefit, the amount that we could write off against our regular income, and again, this is an estimate, it's not perfect, but it's going to be around $40,000 because we're able to bonus depreciate about $96,000 on that property. So it's a pretty big tax savings, and this is on a relatively affordable property, a few $100,000. You can imagine if you buy $1 million vacation home and do this on that type of property, it can be several $100,000 that could potentially be a tax savings. If you're using this strategy to front load the depreciation, all the tax savings, the write-offs in the first year, then obviously in subsequent years on this property, you're not going to have as many write-offs. But I said in the beginning that you could use this method to essentially offset all of your income taxes every year going forward. So how is that possible? Well, it's feasible to think that you could buy a short-term rental every single year going forward and do a cost segregation study on that property. There's a lot of financing strategies out there that don't require you to save huge down payments, especially if you follow my method of buying lower cost, high cash flowing short-term rentals. In a lot of cases, you can 100% finance those properties. So it's very feasible to think that you could buy a short-term rental every year and use this method to offset all of your income taxes going forward into the future. And to me, this whole strategy that I just went through of doing a cost segregation really is just icing on the cake. It's not even part of all the financial benefits that I got into short-term rentals for, because not only is this 3-unit going to give us this huge tax savings by doing a cost segregation study, every month it kicks off thousands of dollars of net cash flow after all of our expenses, which is really the whole reason I got into short-term rentals in the first place, is to give us this freedom that the cash flow provides. But the cost segregation is just icing on the cake, offsetting a whole bunch of your active income taxes at the same time. If you want to learn more about using short-term rentals to get to a place of financial freedom, I personally work with people to help them through the entire process of finding, buying, and setting up their first really high cash flowing short-term rentals. So if you're interested in that, you can go to the link that just popped up at the bottom of the screen and you can set up a call with me. There's a short questionnaire, and then you'll get access right to my calendar, and you can set up a call with me just to talk about your goals and see if the program might be a good fit for you. Thanks for joining me. God bless, and I'll see you in the next video.
you.